Welcome. Today we're going to handle cessation rule. Cessation is all about folding up a business. When a business is being folded up, you might decide to start a business on 1st of January, and you say, I don't want to be in this business anymore. And you fold up by what? February, fold up by March, by June, by April, by whichever month you want to fold up in any year. You can fold up at any time. But the issue is that when you fold up, the tax authority will come for you, and the assessing your tax when you fold up is what we are going to discuss today. But we're going to solve one example. But before then, let's just refresh our mind on what cessation is all about. Mind you, this is before Finance Act 2020. So let's go. Where a business fold up or ceases operation, there is need to apply what? The cessation rule. The cessation rule provide for the what? Determination of the basis period for assessable profit for the last 2 years of assessment. For the what? Last 2 years of assessment. That is to say, maybe you started a business in 2008, 2009, and you decide to fold what? Business in 2010. So here is saying that the profit for the last 2 years of assessment. Now, you started here, your business is still running here, then you decide to fold here. So this is the last 2 years of your business. 2009 and 2010 is the last 2 years. Let's continue. I will explain it more so that you understand better. Now, that's what we call what? Penultimate year. Penultimate year. The basis period for assessable profit for the penultimate tax year is on what? On preceding year basis. The basis period for penultimate year is what? On preceding year basis. The penultimate year is the year before the year of cessation. Did you hear that? Penultimate year is the year before the year of cessation. Now, taking this example here, this is 2009, he started business. He's still running. 2008, he started the business. 2009, he's still running. 2010, he decided to fold up, decided to cease the business. Now, the penultimate year is a year before the cessation. Now, within 2008, 2009, 2010, which is the year before? The year here now is this. This is the penultimate year. 2009 is the penultimate year, and this is the year he sees the business. So what penultimate year is saying that the penultimate year is the year before the year of cessation. This is the cessation year, and this is the year before the cessation. So this is the one penultimate year is talking about, a year before cessation. You understand? Good. Let's see what ultimate year is saying about. Now, ultimate year, this is the year of cessation. This is the year of cessation. The basis period for the ultimate year is from the beginning of government tax year. Now, what is government tax year? Beginning of government tax year from January 1st to the date of cessation. I told you the last time about government fiscal year. run from January 1st to 31st December of the same year. Now, penultimate year is saying that the year of cessation, is from the beginning of government tax year, which is 1st January, for example, 1st January 2020 to the end of cessation. When is the business end? Maybe the business is ending by March, by April, by May. Whenever the business is ending, that is when you made up the accounts to. Now, before we solve one example, let me just give you this scenario. The business, let's assume the business started 2/9. Let me change the date. It run 2/10, 2/11, 2/12. Now the business now fold up here. Know that this is your year of cessation. 2/12 is your year of cessation. Now, a year before cessation is what? 2/11. That's your penultimate year. So these are the 2 years under review that we are looking for. Now, and they say here, for example, let's say the business decide to fold up by April, 30th April 2012. The law is saying that we should assess it from 1st January 2012 to the end of the cessation for this year. But for the penultimate year, it's going to follow a preceding year basis, which is 2/11. We will now assess what? 2/10, because it's on what? Preceding year basis. I hope you understand. So let's solve one illustration and see, please. If you have any question, don't fail to ask, please. Don't fail to ask. Now, let's solve this. Mr. Israel Limited. Mr. Israel Limited. So, the year end of this, we are told to do what? We are told to determine the assessable profit for the relevant tax year. The year end of the business is what? 31st October. That is where they normally made up the account to. 31st October. Continuously, 27, 28, 29. Then they now told us that the business fold up ceased on what? 31st March 2009. This is the year at which the business fold up, 31st March 2009. You understand? Now, the first thing we'll do here would identify our what? Penultimate year. Then after that, we are going to identify our ultimate year and solve using the original basis, because here we are going to, the tax authority will apply for what? Election, right of election. But let's just continue with this one first. Now, the ultimate year is what? Let's check. The business fold up on what? 31st March 2009, which is this. That is our ultimate year. But we are looking for our what? Penultimate year. So penultimate year is a year before the year of cessation. So which year comes before the year of cessation? 2008. And this 2008 will automatically become your what? Your tax year. Will become your tax year. That is to say 2008. And the first year, penultimate year, is on what? Preceding year basis. Now, 28 now will now access what? 27. And 27 ends where? I will normally, the way I do it, I start from the day they end the end date. That's what, so that I can count back easily. So here you have 31st October 27. Then when you count back, you now have 1st November 26. You have something like this. So if you take from here to here is what? 12 months. Then you come here and put your what? 324,000. We've captured this one. Is that okay? I hope you understand. Let's use this and calculate it. Now, they ended the account October 27. Now, if you have to count back, count from October 27. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. As at 1st January 27 has finished, but you are still counting. 10, 11, 12. This 12 now, these 2 months has entered 26. That is how we count back. Hope you understand. Now, the next one now will be 2009. And this 2009 is on actual year basis, because that is the year you are ceasing your business. We'll tax you for that same year you are ceasing your business. If you are not ceasing the business, you are not folding up, then we are not going to do that. But this one, you are ceasing your business for that year. And the law states that for the ultimate year, because this is the ultimate year, for the ultimate year is from first government fiscal year, first, that which is starting from 1st of January to the end of cessation. Now, this is 1st January 2009. 2009 to what? When did they cease this business? Business fold up on what? 31st March 2009. You count your 31st March 2009. Now, if you check 31st March 2009, you find that you see period. It shows that the month is either more than 12 months or less than 12 months. Whenever you see period, check inside that month. It's more than 12 months or it's less than 12 months. Now, from October, you have November, December, January, February, March, to the end of the cessation, where they end their business. You have October, 28, less 28, November. Let's start from here now. November, December, January, February, March 29. That is what? 5 months. So within this period, we have 5 months. They will come here and write 3 divided by 5 times 150. Is that clear? From October to March is 5 months. Count it. It's 5 months. And we are looking for how many months there? Just from January to March. We're looking for 3 months. So you see, the 3 divided by 5 months times the figure, your accessible profit, which will now give us this. Let us add up. 3 times 150 divided by 5, 90,000. So here is giving us 90,000. 324,000. 414,000. Now, we are done with the original assessment. This is the what? The original assessment. Now, the tax authority might say, okay, let's apply right of election and see if we can get a higher pay so that we'll tax him more. Then the right of election will go like this. Right of election is what? On actual year basis. Now, right of election will go from 28 1st January 28 to 31st December 28. Hope you are together. Now, if you check 28 here, you find out that you have 12 months. Just know this. This is where the confusion is always coming, but you will get it. You will get it. Now, we have 1st of January to 31st December 28. But if you check 28 here, you will find out that what we can remove from 28 here is just January to what? To October. January to what? October, which is January to October, which is the remaining months now. November, December is where is included here. You understand? So let's so first 28 to 31st October 28 will give us 180. 180,000. You understand? To give us 180,000. 180,000. Is it going to give us 180,000? No. This 180 here is wrong. I deliberately put it there. Now, what you will do is this. If you notice here, this runs from November to October, will give you 180. You understand? So here now, this figure is a figure that comprises of 12 months. And we cannot lift all of them here. So what we do is this. 10 all over 12 times 180. Let's cancel this. You understand? Times 180. Why? Because we want to remove 10 months. 10 months, which is from January to October, from this figure. Because the total figure here comprises of 12 months. And we need only 10 months. So, this will now be 10 times 180 divided by 12, 150. Here you have 150. $150,000. Then here now the remaining November, December is included in this month. So we do something like this. First November 28 to 31st December 28. Here we now remember we have 5 months here, and we are only looking for what? 2 months. October, November, December, January, February, March, 5 months. We are looking for 2 months. They say 2 divided by 5 times 150. This will give you 2 times 150 divided by what? 5 months. 60,000. This will give you 60,000. Noted? Good. So we are done with 28. So the 29 will apply the same rule, which is from still on actually will now be from 1st January 2009 to 31st March 29. Understand? Which is the same thing we did in the original assessment. Here now will not be, we are looking for what? 3 months over 5 times 150 times 150,000. Let's just check our last distance to give you 90. This will give you 90,000. Now sum these two together. 150, 90 will give you 210. Let me put it here. Will give you 210, and here will give you 90 because I want to sum the two. $210 plus 90 will give you what? 300,000. Now, this is the election rule. This is what the election rule is giving us. And this is what the original assessment is giving us. So the taxpayer now, the tax authority will now say, okay, the first one gave us 414,000, and the election rule will apply. And the election rule we apply is giving us this amount, 300,000. Which do we assess? The taxpayer will now say, let's go for the higher one, the original assessment, which is this, So the taxpayer will be assessed on this. They will not charge him 440,000 naira to pay because this one is higher. So that is all about cessation. Hope you understand. Just hope you understand. If you have any question, put it on the comment section. And if you think that's a way I'm not, if you think there are ways in which I'm doing it that you don't understand, just let me know. I will repeat it for your sake and I will make it very okay so that you understand the more. Ask me questions so that I will know the area you are finding difficulty in this. So I wait for your question. I wait for your question on the comment section. So thank you very much. This is all about cessation. With this, you can solve any question on cessation. Thank you and see you some other time.